Good afternoon, everyone. We'll just wait for a few more people to join us and then we'll get started very shortly. Hi, everyone. We might get started. There are a few more people still to log in and join us. A couple of people have just messaged through that they've had an issue with the link, but I've fixed that up for them. So hopefully they'll be joining us shortly. My name's Craig West. I'm the CEO and founder of Succession Plus. And I'd like to thank you for joining us today. We're going to talk about succession and exit planning for real estate businesses here in Australia. So let's get started. For those of you that haven't used Teams before, you should see on your right-hand side a little chat icon, which means you can type in a question at any time as we go through the presentation. Please feel free to do that. I'm happy to answer questions on the way through. There will be some time at the end as well where we'll answer some additional questions if you need to as well. All right, let's get started. We're going to cover off on a couple of key things, some key trends and latest research around real estate here in Australia, and then talk specifically about succession and exit planning for real estate businesses. So let's have a look at the overall industry at a glance and just see where the business is up to and what it looks like at the moment. Safe as houses, interesting one. Obviously long-term steady population growth and fairly positive consumer sentiment have boosted revenue, subject to, and there's some slides in a moment where we're going to talk specifically about the impact of COVID, which hopefully is coming closer to an end than we were a couple of weeks ago even, but certainly has had an impact on real estate businesses as with many others. Just some revenue data, $26.3 billion industry, quite profitable, and about 40,000 businesses in Australia have their predominant focus on real estate. Just some graphs and numbers around projected and historical growth. So interestingly, fairly slow growth over the last 5 years, 2015 to 2020, but that's projected to double going forward 2020 to 2025, up to 2.4%. Slight decrease in profit margins, increase in wages costs, and small growth in the number of businesses that are actually involved in this particular area. Our property market in Australia, obviously, I'm not needing to tell you this, I'm assuming most of you are involved with or advisors to real estate businesses. Certainly been a strong market, although it's had some dips and troughs with the GFC, etc., and more recently COVID, but certainly a very strong property market here in Australia. Still made up largely of small operators, small businesses, typically franchise businesses that are owned by family groups, etc. A couple of key trends. We've got record low interest rates, and there's no talk of that doing anything other than staying there at the moment. Restrictions have constrained some overseas demand. More recently, COVID has caused some restrictions or diminishing the foreign buyer market, but certainly interesting area around innovation and disruption in this particular industry as well, with digitisation of services coming in with a whole stack of different offerings. We've seen purple bricks previously. We now see a lot of digital and online plays for some parts of the real estate and related business. Strengths, weaknesses, opportunities, threats, pretty obvious, most of them. It's an interesting market to look at, but certainly fairly slow and low revenue growth historically, but also, even though it's doubling in the next 5 years, it's still only doubling to 2.4%, which again is not a fantastic figure. Breakdown, as I said before, largely made up of smaller players, but broken down here in terms of product, certainly property sales, residential property sales, and then property management, etc. Just a breakdown of the revenue break between those various business sectors. And obviously, as I said, in terms of ownership and market segmentation, household owner occupiers still make up a little bit more than half of the market, and then obviously investors and commercial make up the balance. No real market domination, although there are some big industry players who operate within the sector, Ray White Group, for example, only has a market share of 3 to 4%. So it still is quite diversified across a large number of businesses. And of course, Ray White being a franchise operation, a lot of those businesses are actually individually family type businesses owned locally. No surprise here around business concentration. It's spread largely in line with the population, dominated by the eastern states, of course, as are most other businesses. Let's talk about industry performance and some trends that we're seeing within the business. Strong growth through 2016, 2017, foreign property investment, demand for rental properties, low interest rates. Obviously, that's expected to slow down a little bit. Government restrictions on foreign investment, as I mentioned to you before. This just graphs the industry performance. This is a revenue graph year on year as we look at that over a period of time. And you can see the impacts that we're talking about there, and very slow, but fairly consistent growth going forward from 21, 22, right through to 2025. Key external drivers for this business, I don't think this is a surprise to anyone really. Residential housing loan rates, so interest rates are still very low. Consumer sentiment index, which has been knocked about very recently because of COVID, but I think that's starting to turn around now, certainly as things start to unlock and restrictions are eased and hospitality businesses are opening back up. I think that will start to ease and sentiment will start to turn around. Certainly strongly influenced by a massive injection of capital from the government into business owners, unemployment, and a whole stack of other stimulus offerings that have really turned things around quite quickly. Let's look at the industry outlook going forward. Certainly, as I said, small growth numbers, 2.6% projected over that 23-24 period. Consumer confidence, population growth to drive an increase in price and demand over that period, and therefore a growth in revenue, as I said before, of about 2.4% over that period as well. Online and disruptive sort of technology, service providers like realestate.com, domain.com.au, significant threat and have reduced and restricted profitability as people are far more used to. And in fact, just recently, we've obviously had the issue where we couldn't do live inspections or open houses as we used to perhaps do them. Auctions for a while weren't being run. That has caused a quite significant disruption to the service delivery. But people are now far more used to looking at virtual tours on an iPad than they are at walking through a house. It's not the same thing. I don't think it'll ever overtake it, but it is certainly a disruption that we need to be fully aware of. Further emerging risks in 2020, if we look at Aon's, some of the industry real estates reports, one of the big ones is the failure to attract and retain top talent. Real estate businesses, generally speaking, have very high employee turnover, and that's always been the case, and it's not changing anytime soon. Obviously, fluctuation of interest rates and availability of capital in terms of lending in the current environment will be an interesting dynamic to take a look at. Key success factors in these businesses: aggressive marketing and franchising, use of social media and technology, etc., communication, negotiation, developing a market database, and certainly understanding the key markets, and certainly the access to a highly skilled workforce is vitally important to be successful in this particular business. In terms of profit and benchmarks, cost structures, obviously the key costs here are going to be wages, and particularly with largely, although mostly commission-based at the higher end, still a large infrastructure cost being incurred. Let's just briefly have a look at COVID, and then there are a couple of questions there I'll answer quickly, and then we'll move on to the next part of the presentation. Mostly unaffected is an interesting comment there, and I think it's probably quite right, but it's certainly a difficult thing to predict at the moment while we're still in the middle of it. There was quite a lot of talk about property prices being impacted. I think realistically, we haven't seen the impact of that come through yet. There is still a lot of government stimulus in and around the marketplace for employees and or business owners. I think when that finishes, largely around September, October, then we might start to see some stress within the market and for mortgages, etc. And we'll see where that takes us, I guess, is the only thing we can do there. Let me just pause for a second. There are a couple of questions here, so let me just answer those on the way through. Okay, somebody is having trouble seeing the slides. I'm assuming everyone else can see them. Otherwise, I wouldn't have been asked that question. So I'm assuming that's okay. I hope I haven't got a name next to that question, unfortunately, so I can't answer you directly, but certainly it should be working at my end. It's showing that everybody's got visibility, etc. There are quite a few people on the call, so and no one else has mentioned that. So I'm hoping that's okay for you, and you can now see the slides. So let's talk now about succession and exit planning for real estate businesses. Certainly an issue for most business owners within Australia, not just in real estate, but certainly it's heightened in real estate businesses. Typically, we've got franchise owners, particularly that are in the baby boomer generation, and they're approaching retirement, and that causes an issue around succession. This chart shows you the Australian population, the number of people turning 65 years each week. We're currently sitting at somewhere around 5,000 people a week turning 65. They're not all business owners, but some of them certainly are. And that trend is important to understand. That trend is a long, steady growth. It's not a spike. There was a spike back in 2012, which was immediately after the end of World War II, which is what started the baby boom. But you can see the birth rate there continues to increase all the way through to 2029. So it's not going anywhere yet. It's a long, steady growth pattern. And we're only sort of halfway through it, I guess, at the moment. We're sort of 9 years into, and we're 9 years to go, basically. Certainly looking at business owners and the lack of focus and attention on succession planning does cause this statistic. Less than half of business owners successfully extract the value of those businesses upon retirement. That's a pretty damning statistic, but it is what it is. And I think the key to that is to start to plan as early as possible. It's not only in real estate. Only 35% of all Australian businesses have any kind of succession plan in place. So it's a widespread trend. It's not industry specific. No such thing as planning too early. I don't remember ever hearing a client say, I wish I'd started this later. It's certainly, you will get a better outcome the earlier you start the process. So if you are a business owner in this industry, then the sooner you start, the better. You'll get a far better and far more successful exit outcome, and you're far more likely to be able to improve or enhance the value of your business as part of that process. So let's talk about how we actually go about succession and exit planning. For me, starting with a definition is really important. What am I talking about with succession and exit? My view is it's about getting three things right at the same time. Firstly, the business needs to be ready and prepared for a succession or exit event. Financially, both the business and the individuals that own it need to be prepared for a succession or exit event. And personally, those individuals need to be ready as well. And I guess that's not just the owners, that's also the incoming, because an exit for one person is actually an entry for someone else, whether it's an employee or whether it's an external sale. Someone is coming into that business to enter, so they need to be ready, as well as the exiting owner needs to be ready and thinking about retirement, etc. The process we use, we've been using this process for about 10 years. It's a 21-step process that covers all of the things that you need to do to prepare the business, your financials, you personally, your employees, and the documentation and structure that you need around you to successfully exit a real estate business. Not all steps needed by every single client that we work with. We've been working in real estate. I did my first employee share plan for a real estate business back in 2006, one of the LJ Hooker offices. So we've been working in real estate for quite some time. That plan's still up and running, but it's important to understand what some of these steps look like and how important they are in terms of preparing the business for succession or exit at that point in time. Key thing to think about, some of the key questions that you should be asking yourself or your other owners, if there's more than one owner of the business. Timing is important. When are the owners planning to exit or retire? Are any of the employees capable of taking over and owning part or all of the equity? And are they actually interested in doing that anyway? What's the financial position look like? Do the owners require the sale of equity to fund retirement, or is it a nice boost to their retirement funding? Or is it completely irrelevant, which is sometimes the case? Sometimes that's not the priority. Are there growth opportunities for the business? How have we documented them? How have we looked at implementing those to improve the value as we go forward? And what terms are the owners willing to accept? For example, at the moment, we're seeing some business sale transactions going through where the owners are accepting 50, 55, 60% upfront and the balance paid over 2 or 3 years. Now, not all vendors or not all sellers will be happy to accept those kind of terms. You need to think about that well before you have to make the decision. In terms of exit options that are available, this graph shows you, or this model shows you, the various exit options that are available to all businesses. Real estate, being particularly smaller businesses and family owned, generally sits somewhere around the middle of that chart. So it might be a sale to other shareholders, an employee share plan, maybe a trade sale, which is probably a sale to a competitor. Generally speaking, we're not going to IPO or list a real estate business. And at the bottom left-hand side, where we've got family, friends and fools, cheap, quick, easy, but never a great way to maximise value. So it's just about understanding how those exit options combine. On the bottom axis, you've got potential value or sale price, and on the left-hand side, you've got complexity and effort involved, and so need to get a happy medium between those two metrics to come up with the best possible option that suits. One of those options, as you would have seen on that previous chart, is an employee share ownership plan. They are becoming far more popular, and they're being used now in real estate businesses to transition ownership from the existing owners to our employees. This is a great quote from Warren Buffett. I quote Warren Buffett a fair bit. He has a fair bit of sensible stuff to say around business and ownership. Employees are keen to climb the ladder to equity, but someone needs to provide the ladder. Let's talk about what we call a ladder to equity model, which is a steady, gradual process to move from income on the left-hand side, which is typically going to be a salary where somebody starts working, or an hourly rate, to a typical real estate model, actually, which is the income model there at step 2, which is typically a base salary or earnings level with some kind of commission or performance-based booster. Creates a couple of problems, as I'm sure you're aware, in real estate businesses. Firstly, it can create silo behaviour. It typically will see people either discounting or perhaps competing with each other, even though they work for the same business in the same office. And it generally doesn't. It's all based around individual performance. It doesn't focus and engender team-based behaviour. Moving to a profit share plan at step 3 in the middle there will generally step up to better team-based behaviour. And we generally, by definition, obviously, profit share plan certainly looks like it includes and involves expenses for the first time. The 2 other plans around income are all revenue-based. If we start to talk about profit, we're now talking about expenses as well, and we're typically talking about team-based behaviour rather than individual behaviour. My view is that's a good option for some businesses. That's a good place to go. Certainly that can be enhanced, and my view is that equity plans enhance that by doing one key thing: focusing the employees on building the value of the business in the same way that most owners would be focused on building the value of their business. The employee share ownership plan, or having an employee as an equity owner in the business, will firstly change their behaviour. We're still talking about team-based behaviour and profit, but we've now also got to focus on building long-term value, the equity in the business, and that's quite an important distinction. The last step in the ladder then is around control. At some point, if you want to leave or retire from your business, you will need to hand control over to somebody else, and that's the last step in that particular chain. So how do we put an ESOP around all of that? Firstly, some of the benefits for employee share plans. Firstly, there's a predetermined funding mechanism. It is possible to leverage employee share plans here in Australia. Particularly, we've done this already in real estate businesses. Macquarie Bank has lent to some of our clients in this particular space. Obviously, normal credit rules will apply, but there is an ability to fund an ESOP into buying your business. Often you'll see improvements in performance, both from an employee engagement and retention point of view, which is a key issue for real estate businesses, but also continuity after the owner's exit, which for most owners is a fairly significant requirement. And there are also significant tax concessions around employee share ownership plans that can make this as an exit strategy more attractive from a taxation point of view. It's a very strategic approach. And look, there are several pieces of research around, for example, certified employee owned is a movement in the United States where, based on some research that was done, talking about the fact that consumers, buyers, prefer to buy from and are happy to pay more to businesses that are employee owned, which is an interesting sort of marketing angle. You also generally see significant reductions in staff turnover, which is a big issue for real estate businesses, again, as I said before as well. Let's just have a look at the structure and how it actually works to get a bit of a view around what we're doing. We've got our company on the left-hand side, mum and dad as the shareholders or the founders that have set the business up. There's an employer company that sits there. That's the real estate business that's actually trading. We set up underneath that what we call a peak performance trust. It's a trust-based structure that then is set up to do two things. We invite our key employees to join that, and the employees can then buy into that structure. The structure's only purpose in life is to buy shares in the employer company. In fact, it's prohibited from doing anything else. And so this becomes a very useful mechanism and a very clean structure to enable our employees to come into the business as shareholders. They're not direct shareholders, they come in through a trust, and that's quite important for a number of different reasons. But it's important to understand that they do actually own units in a unit trust that own shares in the company. So they do become shareholders ultimately. Certainly focus then is on building the equity value of the business and also getting your employees to think and act like business owners over a period of time. We often use a profit share model, which allows us to fund profit within the business, is used to fund purchase of employee shares. We normally put a profit benchmark in there, and then a percentage of the improvement or the profit over and above that benchmark is then contributed to the employee share plan. Our employees are invited to join the Peak Performance Trust. There's normally some criteria and rules about how that works. And they're then in a position where they can bring employees in, purchase shares in the business. And obviously, because it's an employee share plan, importantly, if they leave, they're disqualified from owning those units, but also the units are discounted if that happens early. Obviously, some other rules like bad leavers, etc. as well. The company contributes profit share into the Peak Performance Trust. That money is then used to acquire shares from the existing shareholders or owners. Each year that happens, we revalue the company, units get allocated each year. That continues on until either we reach a cap. So we've got several clients where the employee share plan has been set up for the employees to own 20% of the business and the family retains the other 80. In other examples though, we've got the employee share plan set up to buy 100% of that business using the employee share plan structure as the vehicle to do that. Because it's a shareholder, along with the original founders or other shareholders, it also receives dividends. If we pay a dividend out of the company, the employee share plan receives a dividend in the same way. Let's have a look at an example. On the left-hand side, we've got John and Jane, who are our shareholders. We've got Smith Trading, which is our real estate business. We've benchmarked up on the top right-hand side the net profit. We expect it to be about 500,000. That's our benchmark. Importantly, if we don't achieve that level, then nothing happens. If we only make $400,000 profit, no contribution is made. But in this example, we've made $600,000, so we're over the benchmark. We've agreed to pay 20% of that excess into the employee share plan. And so down the bottom left-hand side, a check is actually paid from the trading business into the employee share plan. That's tax deductible for the business, but it's not income to the employee share plan at this point. The employees that join now own units in the trust, and the trustee uses that $20,000 to buy shares in the company. That cycle just continues to happen whilst ever the business is continuing to improve and grow. We cycle that money through to buy shares, and that's a self-funding mechanism. We can accelerate that. So employees, for example, can contribute from their own savings, draw down on their home loan, etc. I already mentioned Macquarie Bank lends to real estate businesses to fund succession, and they'll use this structure as part of that as well. A couple of key things just to think about. We're really talking about driving performance, profitability, efficiency, and importantly for real estate businesses, employee retention. It gradually brings in minority shareholders through this process to come in and buy. Importantly, from an ownership point of view, the sell down is documented. So we've got a predetermined sell down strategy for quite some time in advance. Let me just pause and ask if there are any questions at that point before we move on to some of the resources that are available. Okay, so the first question, Greg, I think it is, it's not spelt properly, but that's okay. The first question is around how long does this actually take? So if you use an employee share plan to sell a business, the answer is we can change the timing. We can accelerate this process or we can slow it down, depending upon a couple of key things. What's the profit benchmark we use? And what percentage of profit above that benchmark are we going to contribute into the employee share plan will actually have a direct impact upon the timing. So typically speaking though, in most of the real estate businesses I've worked with, this is a 5 to 7 year plan for employees to gradually buy your business. If you're looking to sell between now and the end of 2020, Christmas time, this is not fast enough. It can be accelerated through the use of debt, as I've said before, but generally speaking, these are gradual sell downs. In an ideal world though, the employee share plan has got a succession plan built into it. You can buy into the employee share plan, and that doesn't have to stop at one person. I've got several plans where multiple employees are buying in, and therefore the ownership of the business is spread across a small number of people rather than just one. So I hope that's helped in terms of the timeline. Oh, okay, sorry. Yeah, so a subsequent question, how long does it take to set, I meant how long does it take to get set up, not how long does it take to work? Okay, sorry, my apologies. So how long it takes to get set up is typically 3 months. So generally speaking, we start with a valuation of the business and an assessment of the financial performance and criteria. We then go away and design the employee share plan rules and documents. We write an employee manual. We also conduct, importantly, part of this is a training session for employees, where we sit down with employees and make sure they understand how this works, not just from a tax and financial perspective, but also what it means to actually be a business owner, how they get involved, how they're better engaged. We run a program called Ownership Mindset, which trains employees to think and act like business owners, to understand what to look at in terms of financials, dashboard reporting, etc., to make sure the plan's most effective. And then month 3 is actually the legal documentation and implementation. There's a trust deed that goes with the employee share plan, employee manual I already mentioned, there's some letters of offer, etc. That's done in month 3 generally. So it's generally a 3-month process. Okay, yeah, so over the 3 months, what does it cost? Typically, it's going to cost about $20,000 to set up a plan like this. We work on a fixed fee basis, so it's not an hourly rate. We'll assess the business up front and give you a fixed price quote to implement an employee share plan in a real estate business. We've done quite a few of them actually in real estate before, and so we know pretty much the best way to make them work, but there is a bit of design and customization depending on what the owners are actually looking for. So if you budgeted about $20,000 to implement the plan, including the valuation that you need to have with it, etc., then you'd be pretty right with that. Any other questions? I'm happy to answer other questions. That's all that have popped up so far. In the meantime, if you are thinking of other questions, in the meantime, some resources just to have a look at, information and so on that's available. I know some of you have probably already downloaded the Business Succession Exit Planning White Paper, which covers some of the material today, but there's much more detail as well. That's free, it's on our website, the link's there. Please feel free to go and access that and download it and read the information. It's fairly detailed analysis of the real estate market and business in Australia, but also succession planning specifically for real estate. I've also written and published a book on employee share plans. Again, you can download it. It's free from our website. You can also get a physical copy. If you'd rather a physical copy than an ebook on the website, please just flick me an email and I'm very happy to post one to you if you'd like. There's no cost to do that. I'm happy to send it out to you for your information to have a look at in terms of employee share plans and how they work as a succession planning tool. My email details are there and mobile number. So I'm very happy for you to contact me through either of those means, and I'm happy to provide further information or answer any questions that you might have. Hopefully we've answered any questions that people have got live today, but I understand if there are others that come up later, please let me know. And if you want a copy of the book, please just flick me an email. I'm very happy to post it out to you without any cost as well. Hope that's been helpful and useful. And gives you a little bit of an idea around some of the things you need to start thinking about in terms of real estate business succession planning to make sure you can maximise the value of your business and achieve a successful exit on your terms when you're ready. Hope that's been useful and helpful. Please feel free to contact me if you have other questions, and thank you very much for joining us.